The government announces the economy grew by 3% last year. The stock market hits record highs, corporate profits surge, unemployment is low. By every official measure, things are working. And yet, your rent is up 40% since 2020. Groceries cost twice what they used to. A night out feels like a luxury purchase. You're making more money than ever before, and somehow have less of it. Something doesn't add up. This isn't about your spending habits. It's not because you bought too much coffee or avocado toast. This is about a fundamental disconnect between how we measure economic growth and how people actually experience the economy. Because here's what most people don't realize. Economic growth and personal prosperity are not the same thing. They used to move together. For decades, when GDP went up, wages went up. When productivity increased, living standards increased. That relationship is broken. The economy is growing. The numbers prove it. But that growth is going somewhere very specific. And unless you're in that specific place, you're watching the party through a window. So let's talk about where the money actually goes, and why the system that's supposed to measure prosperity has become so good at hiding who's prospering. Start with the basic metric. Gross domestic product, GDP, measures the total value of all goods and services produced in a country. When GDP grows, economists say the economy is healthy. But GDP doesn't care who gets the money. If a billionaire buys a third yacht, GDP goes up. If 1 million people get wage increases, GDP goes up. Both are growth. The spreadsheet doesn't distinguish. Here's a thought experiment. Imagine a country with 10 people. 9 of them make $30,000 a year. One person makes $1 million. The average income in that country is $127,000. Sounds prosperous. Now imagine the millionaire's income doubles to $2 million. The other 9 people's wages stay flat. The average income jumps to $217,000. On paper, the economy just exploded. In reality, 90% of people saw nothing. This is not a hypothetical. According to data from the Economic Policy Institute, American worker productivity increased by 62% between 1979 and 2020. That means workers are producing over 60% more value per hour than they did 4 decades ago. If wages had tracked with productivity like they did in the post-war era, the median worker today would be earning substantially more. Instead, the EPI found that typical worker compensation grew only 17% during that same 40-year stretch. The gap between what workers produce and what they earn has become a canyon. And all that extra value, it went somewhere. Let's follow the money. Research from the Federal Reserve Bank of St. Louis shows that corporate profits as a percentage of national income have climbed significantly since the early 1980s. Money that once flowed to workers now accumulates in corporate treasuries and shareholder pockets. Executive compensation tells the same story. The Economic Policy Institute tracked CEO pay and found that in 1965, chief executives earned roughly 20 times what their typical employee made. By 2021, that ratio had exploded to 351 times. Not because modern CEOs possess 17 times the talent, because the rules changed. Stock buybacks played a major role. Once considered market manipulation and effectively banned until 1982, buybacks are now corporate gospel. According to Harvard Business Review, S&P 500 companies have spent trillions over the past decade repurchasing their own shares, artificially inflating stock prices and enriching executives whose compensation is tied to share performance rather than investing in wages or infrastructure. Then there's housing. The Joint Center for Housing Studies at Harvard found that between 2001 and 2022, median home prices increased by 98%, while median household income grew only 19%. Housing, the primary wealth-building tool for average Americans, has been transformed into a speculative asset for institutional investors and the already wealthy. The financial architecture has been redesigned for people who already have money. If you own equities, real estate, or business interests, the past 15 years delivered extraordinary returns. If you depend primarily on wages, you've been treading water while everything around you gets more expensive. The economy is growing, just not for you. Here's where it gets darkly funny. Inflation is measured by the Consumer Price Index, maintained by the Bureau of Labor Statistics. The CPI tracks a basket of goods the average household purchases. Sounds reasonable. Except economists keep adjusting what goes in the basket. If beef becomes too expensive, the formula accounts for consumers switching to chicken. If chicken gets pricey, the methodology adjusts again. It's called hedonic adjustment and substitution. The underlying logic: people adapt to higher prices by buying cheaper alternatives, so real inflation isn't as severe as it feels. This is like telling someone their quality of life hasn't declined because they downgraded from steak to instant noodles. Meanwhile, the expenses you cannot substitute, the ones you actually need to survive and build a future, have skyrocketed. According to Pew Research Center, housing costs have far outpaced wage growth in virtually every major metropolitan area. Healthcare spending continues its decades-long climb. The College Board reports that tuition and fees have increased roughly 180% since 1980, adjusted for inflation. You can't substitute rent with something cheaper and still have shelter. You can't replace necessary medical care. You can't swap a degree for a free online course and expect equivalent career prospects. Yet, these essentials don't dominate the official inflation calculations the way they dominate your actual budget. So when headlines proclaim inflation at 3% while your rent jumps 15% and insurance premiums spike 20%, the disconnect isn't imaginary, it's mathematical. This isn't a conspiracy. It's incentive structures playing out across decades. Policymakers chase GDP growth because it's quantifiable and makes for positive sound bites. Corporations pursue shareholder value because fiduciary duty and market pressure demand it. Investors optimize for returns, not societal outcomes. Nobody wakes up plotting to hollow out the middle class, but systems don't require malicious intent to produce harmful results. What we're witnessing is the accumulated effect of policy decisions made across decades. The Rand Corporation published research in 2020 estimating that if income growth had remained as equitably distributed as it was in the decades following World War II, the bottom 90% of Americans would have earned an additional $47 trillion between 1975 and 2018. $47 trillion. That money didn't vanish. It redistributed upward. Tax reforms that disproportionately benefited high earners, financial deregulation that unleashed speculative excess, the systematic weakening of labor unions, which, according to the Center for American Progress, once represented over a third of workers and now represent barely 6% in the private sector. Wage stagnation normalized as inevitable rather than challenged as policy failure. Housing reframed from a basic need into an investment vehicle. Each individual decision seemed rational to someone at the time. Collectively, they built an economy that expands on spreadsheets while most people feel financially squeezed. And here's the uncomfortable part. Those benefiting most from this arrangement are the same people with power to restructure it. The wealthy don't experience the crunch. Politicians remain largely insulated. Executives thrive. The economy functions precisely as intended for those who shape its rules. So when you hear the economy is strong, the correct response is another question. Strong for whom? There's a trap embedded in all of this. When people feel economically squeezed, they search for villains. Immigrants, foreign competition, the opposing political party. It's psychologically easier to blame individuals than interrogate systems. But research from institutions like the Urban Institute shows the housing crisis stems from restrictive zoning, misaligned development incentives, and decades of insufficient construction, not immigration. Studies from the National Bureau of Economic Research indicate wage stagnation connects more to weakened labor power and policy choices favoring capital than to outsourcing alone. The frustration is legitimate. The anger is earned. But misdirected rage doesn't repair broken machinery.
It just consumes energy while the underlying mechanisms continue operating. The economy doesn't respond to your frustration, it responds to leverage. If you possess assets, networks, or capital, the system serves you well. If you're starting from nothing, you're scaling a mountain that grows steeper annually. And those at the summit will continue insisting the economy is flourishing. So here's where we are. The economy is growing. That part is verifiable, but growth and shared prosperity are entirely different concepts. You can have expanding GDP alongside a contracting middle class. You can have record corporate earnings coexisting with widespread financial precarity. Both realities can be simultaneously true. The question isn't whether economic growth is occurring, it's who captures the benefits of that growth. Currently, the answer is unambiguous. The system operates exactly as designed.
It's simply not designed with most people in mind. And until we start evaluating economic health by whether people can afford housing, healthcare, and stable futures, rather than whether investment portfolios reach new peaks, this chasm will continue widening. The economy is growing. You're not imagining the rest.